Hi, good evening everyone. And अभी तक सिर्फ debt, right? We were having debt and now it is equity. But both are PMS, by the way. So minimum investment is 50 lakhs, right? So just keep that in mind. And let's start with a very generic question first, right? For all my panel members here. We all hear, right, Achhe Din, we all hear about great India growth story. So maybe I want you guys to just pick one particular macro level aspect, which you believe is the one which is driving force and will India will see the great times coming ahead, right? So maybe we can start with you, Amit. Yeah, from there.
So one macro factor that I see that will be the biggest game changer, and that is guaranteed, regardless of governments, regardless of what happens in China, US, is the growth in per capita income. Today, our per capita is about $2,200-$2,300. This will move to $5,000, $7,000, and this will be the biggest game changer. If you look globally, we are exactly where US was in 1982. US was a $3.5 trillion economy in 1982. We are a $3.5 trillion economy today. In America, between 1982 to 2000 was the biggest bull market. The penetration of equity in America was 3% in 1980. We were at 3%. In 1980, US was a $3 trillion economy. In 2021, we were a $3 trillion economy. Our penetration was 3%. Between 1980 to 2000, equity penetration in US went from 3% to 50%. 20 years, the penetration of equity in 1980 in America was 3%. Year 2000 was 50%. If you see patterns across the world, when China per capita income was in 1996, China per capita income was about 2,000, same that we are at, to $2,500. The penetration of AC in China was 5%. In year 2006, 1996 penetration of AC was 5%. In year 2006, penetration of home ACs in China was 82%. From 5% to 82%. We are going through, and the biggest secular trend is change in, बस पैसा earnings change होती है, सब कुछ change होता है. You will find the brands that you are wearing very inferior. If you are consuming an Old Monk, you will find Old Monk inferior. You want to move to a black label. If you are consuming black label, see, it's a Saturday, or you cannot speak about coffees and tea all the time. So basically, everything changes. The biggest secular macro trend in India is per capita change in income. Multiple countries have gone through this, and we are going to see this. It happened in Dubai in 1996 to 2008.
So basically, अपना time आएगा.
अपना time आएगा.
अपना time
Yes.
आ गया है in the DGDP
Yes.
growth. That's the one macro which you are talking about. Great. Over to you, Amit.
Yeah, probably taking off from where Amit spoke of. I think one of the drivers to that inflection that you see, is the demographics of India, right? So, and again, if you go back and take the same comparison versus the US, right? One of the reasons why they saw that huge secular bull run for a few decades, was that the baby boomers phase, right? So, if you look back at India right now, we're actually at a baby boomers phase, and this is sort of, hopefully we will see that, couple of decades of growth. Why does this happen? This happens because you have a whole lot of people who are, say, below the working age, who are coming into the working age, and that increases the whole economic growth, right? If it's at a small percentage, it may not have as much as an impact. But just look at it where it's a large percentage of people coming into a working age and earning, you find the economy flourishes, and then you also have some of the other consumer durables, etc. All the black labels of this world and stuff like that, also get consumed. Okay, so I think that to me is
absolutely. So basically, whatever it is all about the demographic dividend which people talk about, right? That India will reap the rewards on. Yeah, Sonam.
Yes, so I think wonderful answers from both you guys. And I would just bring in a flavor of our brand, which is using data and technology. So I think the adoption of technology across India, right, is one of the things that would make a change. And we're sitting with these people coming from sort of the technology capital of India in Bangalore. I think the penetration of these digital products is what has actually led to the change, right? Payments become digital. You have UPI system which has brought in so much business across India. The KYC stack is digital, and across the board in different industries, AI is evolving, and so much is happening. I think that will sort of promote penetration of the different products, of the different services, make people more educated, and bring widespread sort of growth across India. So I think that would be one of the drivers. I think this would be.
No, definitely. I think people call it as a jam trinity, right? That technology, mobile, Aadhaar, and the internet, all three put together, is going to race India towards the progress, right? So, absolutely, very well put. Please.
Yeah, so let me give a very specific point. Uh, I agree what Amit said about the per capita change, but why will per capita change or accelerate from here? The independent variable is going to be that India's growth differential versus the West and the world is going to increase further. Let me give an example. Earlier, the growth, world GDP growth used to be 6-8%. Now it's at 3%, and India was also growing at 8%. Now the world GDP growth and the developed economies have decelerated their growth significantly, whereas India's growth is actually increasing. So let me break that myth that the world needs to grow for India needs to grow. And the evidence of that is 60 to 95, when world GDP grew at 10% CAGR, Japan and Korea, Japan GDP grew 100x, Korea GDP grew 234 times. Similarly, from 95 to 2015, when world GDP grew at 6% CAGR, China grew at 18% CAGR. So let not any strategist or media or anything tell you that the world needs to grow for India to grow. The macros and everything else is favorable both in absolute terms and second, relative to the whatever your peer set is. To my mind, we used to always say there are 3 countries in the world only. 190 countries in total, but there are actually only 3 countries in the world, US, China, and India. Now, there are only 2 countries in the world which can attract investors, capital in any form, projects, etc., which is US and India. There is no third world which can actually attract $100 billion of investments every year.
Amazing.
Actually,
Amazing. Yeah.
if I can butt in, you said just one parameter each, right? I think we're doing injustice because it's actually the confluence of so many parameters, right from entrepreneurship, okay, right from lower interest rates, China plus one. I think you can just go on and on, right? Like all of them are coming together. Right?
Correct. Yeah. So idea was to get one parameter from each one of you, and that is a confluence which is actually helping the India to grow. And very well put, Varun. 2 points you have covered actually. One is on the China plus one, as Anil summarized it, and second is that India is not dependent on something to happen outside. Right? There is a huge market and the things which companies can take benefit from inside. Right? So that's good. So I'll start with you. Specific question on basically forget the recent Israel and Iran thing which is happening. Let us say, but still we have seen that the volatility is very high, right? In all the current market scenarios. So what do you, in India especially, and what do you attribute it to? Profit booking, or is it external factors, or is it a combination? I mean, how do you see this volatility panning out? And
to my mind, actually, we've had the calmest equity market in the last 8 years, right? If you go by statistics or if you go by evidence of the market, we haven't seen a drawdown. COVID was a drawdown, which was very sharp and the markets recovered. We haven't really seen, so we haven't seen volatility yet. My family goes back into markets since '82. I joined the profession in 2000. I have seen at least 5 bear markets and 3 major bull markets. This last 5 years of bull market actually has been smoothest. And who would have imagined that 2019 tak, our index returns were like 11% CAGR preceding 10 years, and today it's 16-18%. So the biggest returns have been made in the most unexpected period, which is post-COVID. And let me provide the macro backdrop. 5.5 lakh crores of profit, 2019, today has become 14.5 lakh crores. Today, India's corporate profits are at $176 billion and close to $230 billion of cash flows. And while the world has levered, India has delevered. So make no mistake, don't get distracted. The right thing is, over the last 20 years, itne wars ho gaye hain, demonetization, GST, bank crisis, you name it, every macro event has happened, and yet both corporate profits and obviously the consequence of corporate profits is markets recognizing those have only moved up to our surprise. And obviously the first factor that I mentioned was now the world is finding lesser and lesser places to go and invest. Most of the BRICS, by the way, have become frontier markets rather than emerging markets. And I beg to differ if the media calls India an emerging market. Today, EM has become DM, and developed markets, because of their leverage growth issues, are actually behaving like emerging markets. So, volatility we haven't seen yet. There could be a storm lurking because it's too much of calm. Everybody knows the election outcomes. Everybody knows ab ki baar 400, and then the reforms will happen. Markets always do the unexpected. Final point, Donald Trump, markets were expected to crash. It actually rose. Congress 2009, the markets were expected to do badly, but actually markets went 2 circuits up. Expect the unexpected.
Okay, so despite the volatility, you believe the bull run continues. Okay. Next question to you, Anil. What are the strategies that work well in the current market conditions, particularly the geopolitical tensions, right, which are there, and all this possibility of rate cut, inflation everything is like taking time. I mean, it's not happening. Everyone is expecting it will come. It will come. So, what are the things? What strategies will you think will work?
First of all, I don't think, should you do something different, right? When there's volatility, I believe it's about continuing to be disciplined in your investing style, investing strategy. For investors, it's about asset allocation and being within that, not getting carried away, and you're taking advantage of the market cycles. All of those are there. So I still believe that broadly for most of what you do, okay, there's nothing that you need to do differently, right? Follow your process, be disciplined, go deep dive, at least when you're looking at companies that you invest into, and so all of those are definitely some things which you need to do and are taken for granted. What can you do maybe a little bit differently? Again, is a question, because there's a lot of hype about markets at a high. Right? Markets at a high almost every year. If you go back and look at statistics, right? There's nothing about markets at a high, and looking at valuations as a absolute number is ridiculous, right? Markets are high if you look at relative valuations. And the question today is are relative valuations very high? I don't think so. The relative valuations are very high. So it's still not time to do those really drastic steps and decisions there. At a time like this, let's say the only thing you look at is maybe there's some pockets which are done really well. Okay, if there is volatility, then you'll see some bit of corrections out there. Slowly, maybe if you're looking at expand a little bit away from the mid and small caps, slowly start going slightly more diversified, because again, investors I think tend to just jump into whichever is doing the best, right? And then suddenly you get the worst, because by the time market has moved the other side, right? So I think that discipline, that saying that how do I still allocate, not just get carried away, and at a time like this, maybe you have to be a little more cautious. And our concern is maybe from global markets, so you could see volatility, and if that is so, I think take advantage of the opportunity.
Got it. You wanted to add something into this?
No.
Okay, great. So my next question is to you only, Amit. That It is understood that manufacturing will be a key theme, right, in the investments, right? Whatever you see, make in India and so much of push. And what are the dominant themes you believe are expected to shape in the market in the FY25?
See, I've FY25 only this year.
Maybe next 1 year or 2 year if you want to
See, I'll
cover,
tell you
yeah.
something. For next 10 years, 15 years, 100 years. The best part in our business is every 90 days, you're coming to know who's performing well, who's not performing well. जहां जहां growth दिखते जा रहा है, वहां वहां we keep investing capital. We keep bonuses. We give bonuses to our entrepreneurs who are performing well. Every 90 days you come to know. Who knows what will happen in 2027? Who knows what will happen in 2026? I don't know what will happen next quarter also, very honestly. And my investments also, my goal is that in every sector, be it shoe, there is one guy who's gaining market share. Assuming red tape, he's gaining market share from Bata, Campus, Metro, etc. In fashion retail, Trent, which has Zudio, Zara, etc. Zudio, Zara, Westside, and Star Bazaar. He's gaining market share from all other players. In food delivery, there is McDonald's, KFC, Domino's, Barbecue Nation. All these guys are growing at 5%, 7%. But you have Zomato, which is growing at 69% last quarter. This quarter should grow at 75%. In every industry, we have market share gainers. My goal is to identify them early and ride with them. What will I do? India's nominal GDP growth is 14%. And I want to compound capital at higher than 14%. Then you have to be in companies that grow at higher than 14-15%, right? How will a company which is growing at 5% compound your capital? Every 90 days, you're getting numbers that will decide the next big trend. Make in India and all these are all stories. I don't listen to stories after these sessions. 2 years back, they were saying chemical is a big story. Today, chemical stocks are down 50-70% and no one speaks about it. But you could see, right, that margins had expanded, pricing बहुत ऊपर हो गया था, pricing बहुत नीचे हो गया. See, all these are good stories. Beyond a point, every 90 days, you have to manage your own risk. Your fund manager has to manage your own risk. And we are very dynamic. I myself don't know what will be my portfolio 1 year, 2 years from today. But I can tell you, I will be the best with the best performing entrepreneurs of that time. So, future I don't know, but my process I know.
Got it. Yeah, please.
On the manufacturing question, 270 companies, private and PSU combined, that are majorly in manufacturing. The total market cap is around $900 billion. The profit is 27 billion. Now, in a country of this size, obviously, jo bhi hua hai last 15 saal mein, manufacturing was underinvested. Let me ask to reflect back, is $30 billion really the true reflection of our manufacturing competence? So I think manufacturing cycle has just begun. Power sector is going to do close to 30 lakh crores. 30 lakh crores of capex in the next 5 years.
Okay. Next question to you, Sonam, on this. In a landscape where everyone seeks to generate alpha, right? Everyone talks about alpha. But in a PMS, how a firm can establish distinctive investing style that set them apart from others? I mean, there has to be a way in which you can do that.
No, definitely. I think, like Amit said, that, every quarter and every few months, themes are emerging. And, there are distinct themes in the market, right? So we really see something like momentum investing, chasing the trend works well. Along with it, somebody else might be doing high quality investing, right? They pick very high quality stocks and somehow they end up doing much better in the market. You would have somebody who's looking at valuations, picking the real value stories which are undervalued and they could do well. So there are distinct themes in the market that do well. And I'll tell you one thing, that none of it will work all the time, right? So if I am doing momentum investing, I'll do good in one market, but there will be a scenario where momentum is not doing well. Somebody who's doing value will take over. So I think the idea is to keep an eye on the market, understand the themes that are out there. There's no one answer. Nobody will have one answer. There will be emerging themes. Last couple of years, we've seen this Make in India theme really come up. Which was not in any books, but it picked up. A year back, you were looking at high inflation, and suddenly you had to pick up that as a theme. Now next year, or maybe hopefully this year, we have to pick up low interest rates. I hope they come, and we start looking at that. So themes are emerging and changing. Market is extremely uh, wide and diverse. There's so many people participating in it. So a bunch of themes and a lot of interesting stuff that you have to keep your eye on.
Got it. Got it. So basically, keep a mind open when you're taking a leap from that itself. And not everything will work. That's in every time, right? You cannot be chasing every time growth or momentum or.
Recycle new story. And if you're in the old stories, you will underperform. One cycle you'll do well, next cycle you'll underperform.
Yeah, or you have to have patience to hold on to it when it
No,
performs.
see,
Right.
even if you have patience, your clients don't.
Nahin,
See,
that's
all
correct.
investors are long term, but everyone checks their portfolio at 3:30 p.m. Over time, sir. All my investors.
How many of you agree with this question? I'll just take a quick show of hand. We check the portfolio at 3:30 p.m. Okay.
And I'm telling you, you underperform for 3 years. Fundamentally, I'm telling you, you are only as good as your last 2-year returns. Your last 2-year returns are bad, you go from a rock star to a rock. And your last 2-year returns are good, you go back to being a rock star. See, we live in a world where we are in a Blinkit world, yeah. So we are in that world where.
And Blinkit also is acquired by Zomato, by the way. So,
Yeah.
yes, I understand. So, next question to you, Varun. On these two themes, right, quality and value, do you see that these themes have changed or evolved over a period of time, or they remain the same? Because there are so many fiascos which happen, right? ILFS, this, that. I mean, so how can actually one be sure that value is not becoming more valuable, or quality is going to test the time, right? It can stand the test of the time and remain quality, right? So do you do any thoughts on these two?
There's an old saying, there are old investors and there are bold investors, but there are no old and bold investors. Okay, the kind of multiples, valuations, etc. of simple companies. Consumer companies are relatively simple, and that's where you come. Quality got assigned to mainly consumer companies. They were growing at much lower than nominal GDP growth, and their multiples were 3 times of that of the index. So it was actually, had somebody spent enough time in the market, it's a no-brainer. Having said that, coming back to the question to answer quality versus value, and then there is this large cap, mid cap, small cap. With all humility, we as a team never look at the markets. These are actually created by either regulators or it's not needed. So what do we call it? Our investing is scale change. We call it scale. 100 crore का profit अगर company का 300 crore हो सकता है, 300 crore का profit अगर 1000 crore हो सकता है, does it matter in terms of size? There are several industries where large companies dominate and are growing faster. Let me say, in terms of lending, in terms of insurance, in terms of capital market, there are several industries where large is a liability, being mid and small is actually your biggest asset. In IT, in SaaS, in consumer retail, there are, so make no mistake about bucketing, classifying, getting straight-jacketed by these. Quality and value are joined at the hip. And what really matters is rate of change and change of rate. If there is a perception change in quality, both negative or positive, that's where the biggest wealth is created. There are so many companies today which have changed their perception, or the industry cycle has benefited them and they have become quality today. And there are so many companies which are quality under-delivered and they're derated. Let me give you a hard fact. Yesterday's data, Hindustan Lever results have come. Okay, Hindustan Lever, Dabur, and there are so many other FMCG companies. They have not beaten your FD returns in the last 5 years, and they've given lower than index returns in the last 10 years. These are some of the highest quality companies. Beyond the point, return on capital does not matter. Return on capital above 20% but growth is the biggest independent variable. Now, growth has to come at a reasonable price, and that becomes quality growth at reasonable price, as simple as that. They are not disjoint.
Okay. Next question to you, Sonam, on where do you think HNIs who are investing into various alternate assets, right? And how do you see this alternate investment landscape changing?
No, I think there's so many interesting products out there. All my co-panelists have amazing products, right? That are extremely popular. I sort of really believe that the quant space is something that we are doing where we are using data-driven methods and quantitative philosophies, which is not very widespread in the India market. It is an extremely small portion of the overall capital allocation is going to grow. Data-driven methods, provide a sense of objectivity to what you're doing. We have a very well-defined process and a well-defined systematic philosophy that we have optimized across times. We use risk management methodologies or a little bit of AI to optimize these things. I think that appeals to a lot of new age investors, people who are coming with a lot, especially the tech folks, especially people coming from these educated backgrounds. They're adapting more and more to that. I would assume and I would hope that in the next few years that gets a piece of the pie. But along with it, India definitely has so many other avenues that will come and take their space in the alternative field. So I would hope more long short fund comes, better debt structures, right, and more diversified sort of equity offerings, stuff happening in the PEVC space. So many interesting, which has been lagging for a while. I hope that
Correct.
also picks up. So a lot of interesting stuff.
Amazing. And Anil, to you, next question. Where would you recommend HNIs to invest their money? Obviously, your fund is one, but yeah.
I didn't say that. Okay, so actually, I probably asking the wrong person because I'll still say equity. Okay, equity. I think from a long term is still the best thing to do. I think it's a little different. Let's say from an investor standpoint and let's say from our standpoint. I think from an investor standpoint, I still believe doing the boring things, okay, actually makes sense. So how do you look at asset allocation within that? Okay, how do you, again look at long term? Maybe choosing the asset managers who have a different style is something that sort of may be important to do because I think that's what in some form brings diversification, right? So I come from a view that risk management, I give higher priority to probably even returns as long as you're putting it in the right place. So for example, this is why we have various strategies there. An investor then can choose to say, I want to put it into a small cap fund or a mid cap fund, or at some point you may say, I just want to be in a large cap fund. So at this point of time, I would still say equity. Within equities, I would believe the phase where we saw super normal growth for mid and small caps, I don't know if it will outperform in the same percentage going forward. I would think that I don't expect mid and small caps to come down, but I think that you'll also see a slightly more broader based rally, possibly with FIs, etc., coming in post elections, hopefully. So those are aspects there. But if I look at beyond, right, it's about, I'll still say asset allocation beyond equity. What do you do? Gold is interesting. In fact, I don't think people realize the impact of putting it together along with equity, right? And if you, in fact, we have a high multi-asset fund, and that's done super normal, and a big contributor for that is gold, right? Because that actually has given a bit of a kicker out there, and I think there are reasons for gold also to do well. As much as we are, some of us are indiscreet on how we manage our cash flows and deficits, etc. I think the governments are far more, right, industry, especially starting off with the AAA rated economies. So that is something, gold is something that one would like to look at. And I think the alternates, we have the alternates seminar, right? So there, again, how do you choose between various opportunities that you have, right, from unlisted to, debt, maybe mid-yield, high-yield debt, etc. I think that, so putting it together, of course, one caveat there is, some of the diversification depends on the value of your portfolio, Right? I cannot be investing in, a lot of the AIFs if, my portfolio is smaller. So you need to have that, some of those risk management points for yourself. How much can I put into alternates as well? I think that to me is, looking at a more diversified approach. And of course, equity trumps it all.
Okay, equity, big equity fan. So over to you, Amit. In the context of alternate investments, right? Which asset classes are likely to gain performance say, over the next 3 to 5 years, right? How do you see this space?
So alternate is a smaller space, but about asset allocation, my point is for last 30 years, gold and Sensex has given same returns. Sensex, just Google this, and 30 years before today, Sensex was at 4,000. That is in 1994. Gold was also at 4,000. 20 years before today, today Sensex and the gold are at around 70,000 plus minus. 20 years, so much has been said by we panelists. Actually, 20 years, gold and Sensex has given same returns. You go 10 years, gold and Sensex have exact same returns. So
This is a very controversial statement. Huh?
No, so-
people say all housewives are putting in gold, not a good decision. You're
No,
saying
they
they are
are-
doing a very wise, good, great decision.
See,
Huh?
basically, if you don't create equity markets, and this is data, so you cannot fight data beyond the
Yeah,
point.
sure.
If 20-year returns are exact same, 10-year returns are exact same, and 30-year returns are exact same of a index, equity is not like gold, where everyone makes the same amount of money. This is capitalism. This is some people will compound at 5%, some people will compound at 10%, some will compound at 15%, some will compound at 20%, some will compound at 30%. It's a game. If you want to do ETF investing, so ETF, gold, broadly, they'll give you same returns. I'm just telling you, based on data. And you can also keep your wife happy. So that's a plus 1% return that you have to add. But this is data I'm telling you. But equity markets about alpha creation. See, I invest all my eggs in one basket. And fundamentally, on this alternate industry, this is all about confidence. Over time, you'll get confidence that what is my goal of life? I believe, and I fundamentally believe this very strongly. The next 10 years, if you don't change your net worth, it's not Modi ji's problem, it's not India's problem, it's your problem. The opportunity is large. In India, entrepreneurship is 100 years old. Hyperscaling is 10 years young. Entrepreneurs are dreaming big and they are executing it very large. No one's thinking to be small. Like I speak to so many, my clients are entrepreneurs and the people I invest in are also entrepreneurs. The next 10 years gives you an opportunity to change your net worth. Boss, you cannot say, I want to make 5 crores, 2 crores. That is thinking small. Think big. Like, I'm a dreamer and I try to then execute my dream and make it large. But I fundamentally believe this is that period of 10 years that US had in 1980s to 2000. उसके बाद पैसा नहीं बना है बॉस यूएस में. That Dubai, which happened in 1996 to 2008, that is where your biggest billionaires. Today there are 171 billionaires in India. Believe me, this number will be 4, 5, 7, 10x higher in the next. And in the world there are 3,200 billionaires. The vision, capability, execution is all changing. It's a once in a lifetime opportunity to change your net worth. Yes, think big, yeah. This is our time.
Very, very controversial statements. Wife का happiness सिर्फ 1%, huh?
Sorry.
Wife का जो happiness था उसका additional से 1% दिया आपने. Okay. So what do you, Varun? A bit on your fund strategies, right? When you pick a sector or a theme for your investment, how do you plan for their exit strategy?
Sure. Just one point I want to on the gold versus equity debate.
Sure.
Last 20 years, gold returns 13.5% CAGR, the gold MCX INR, and partially it's because of the depreciation, not as much as the gold USD. Gold USD is 9% CAGR versus India gold at 13%. Now, the difference between a 20-year return in a 13.5% versus index has given 16-17%.
Active funds have given close to 18%, has been 13x versus 20x. Okay. Now that extra 7x, is it material for you? That for everybody to decide. Dusra, there's something that is not communicated. When we see gold returns, we see on the screen, there are taxes, there is making charges, there are transaction costs. If you reduce that, gold returns are far lower. Equity, 10% long-term capital gain, you get what you see. Okay, there's a huge wedge. Now, the only point to answer about your exit, but if we have children, I've always said this for 20 years, make equity your first child. When you are planning having a child, to grow up children, it takes, let's say they grow up by 16, 20 years, and you start your investment then. By the time the children grow up, your equity investments will be equal to take care of their entire legacy and expenses. Unfortunately, equity is treated as a an orphan right now in this country. Only 5% equity is invested, rest goes to real estate and all that. इस साल खाली 1 लाख करोड़ आया है equity में in through SIP and all that. 1.5 lakh crore. The country's savings are $1 trillion. Barely 5% comes to equity. So, long story short, make equity your family member and your first child. It will have its tantrums. It will have its own journey, just like parenting is. But the end of 10 and 20 years, you will have a grown-up asset which is performing for you. About our exit, when we invest, we do not plan for an exit. We are looking for structural, long-term, 5 to 10 year themes which should deliver in 3 to 5 years in terms of profit performance. But ideally, we're looking for longer themes. So just like when you befriend somebody or you are on a date or you get married, you don't plan your exit. So our exits are an outcome of 3 saal baad, every 6 months you're anyways reviewing, every 90 days you're anyways getting your results. But we do not plan the exit because markets could give you gratification earlier and sometimes you have to wait much longer than you're planning. But gratification will come with patience.
Okay, thank you. Sonam, for you, we believe that usage of quant models is one of the things which is core. But do you see that it will evolve to a level that it will become independent for the whole investment process, right from investments to allocations to exit, without a human intervention? I mean,
See, so we have a quantitative approach, and quant doesn't mean that an AI is taking decisions. That is not the case at all. It's a system where we are spending hours and days and so much time in trying to perfect it and sort of do make sure that it's doing the best it can. And I have a system I've been running for 5 odd years. It's done well, but then I don't think it's perfect, right? I don't think it has all the answers. And every few months we'll find out something that we're not covering, right? So I'll give you an idea. We have some momentum exposure in our portfolios. We realized somewhere in the beginning of this year that we had a lot of PSUs in that basket, and we did not have a limit on that exposure, right? So we ended up optimizing it and making sure that if I limit that exposure, what happens? And I changed my system and see that at the end of the day, that's my job, that I sort of spend time on the system, optimize it, make sure that it is covering everything it can. But a systematic approach definitely has a lot of advantages. It removes that subjective bias every time, right? That my mood changes. I don't trust my mood, but I do trust my system. So I might take this call or that call, but if I'm following along a system, it will always have that objective decision making. It will have that objective asset allocation call that, okay, risk looks high, let's go a little bit into the allocation or introduce a goal or something. It comes objectively, and it also gives me a lot of validation. If I'm seeing all these experts managers doing the same and my system is doing the same, then that gives me a lot of validation. So yeah, definitely. See, I think systematic approach has a lot of advantages. And I definitely think that the adoption of it is going to grow a lot. I really don't, I will not use AI to take decision on people's money because, I can't, I'm also not that confident to have a black box to it. But, there are definitely different aspects in the whole process where AI or different technologies can really enhance what you're doing, and which is, what we love to do. So
basically, I'm making the whole thing efficient with your intervention. So right now, it's not seen ki human intervention not required for.
No, see, there is research, and there is a lot of research and a lot of fighting with data that we have to do to build that system, which will always be there. But yeah, the system sort of provides an objective sort of way to participate, and it's not an AI that's taking decisions at all. Right?
Got it.
Yeah.
Got it. Anil, to you, I know Right Horizon follows a pendulum, and then there is a scorecard. In a volatile environment, how do you think these factors affect your decision making?
Yeah, like I said, I think it's about how do we make life boring. And as part of that, also saying that how do you make it more difficult for ourselves to invest, right? So, and I think from there come the winners. So we are a huge fan of process. Okay, some of it comes from me, from having worked in Wipro here. Okay, on the technology side, technology company, but on the finance side. So process is a very, very core part. So scorecard, for example, is one of the processes where we actually rank all the companies which come into our screener, which is our first process. Then we have a risk management process, and then the pendulum that you mentioned, right? So each part of it is a separate process for us, and I think the important thing which comes out of it is that then you have a smaller list, okay, but can we depend on that? To some extent, I think alpha comes from going deeper, right? So beyond whatever sort of past metrics, because a lot of them are backward looking, you have to look at what does the company do, what are the company's strategies, right? Is there tailwinds out there, okay, and various other factors. Are they able to have pricing power? I think we spoke of Trent and stuff, and you can see that they've been able to, for a long period of time, manage some of it there. So within the whole investing journey, I think process is very fundamental to what we do. Okay, it is the foundation. Okay, from the foundation we actually go and build and try to get that extra alpha, hopefully, which will deliver long-term return. But what this does for us, okay, it ensures that we are consistent. Okay, so interestingly, you will find that we've done reasonably well even on the COVID fall. I mean, some of our funds, fell lesser than the index in a period when many others actually were taking a higher level of risk to deliver a higher return. So something like that. And at the same time, we were also able to take advantage of the uptick that happened subsequently, and also, we're able to get some alpha out there. So I think having process definitely, has helped us, look at it objectively, because even for investors, right? And that's what I think also differentiates a little bit a professional versus maybe investors. Sometimes we get carried away, we get married to the stocks, okay, that we invest into. And so this, what it does, it takes away our biases, okay, which is a very, very important thing to do.
Got it. To you, Amit, you have talked about your investing strategy a bit. So just elaborate there, because I know there are two styles, that is proven monopolies and emerging monopolies. So how do you basically find these emerging monopolies? And what is the impact of sudden changes, like in startups or in emerging economies, or typically monopolies typically happens is funding is important or extra cash is important. If the suddenly dynamics change, how that impact can be even higher, right? So how do you manage that?
My portfolio volatility, the third question first. My portfolio volatility, if you just Google Nifty standard deviation today, it's 23.06%. My portfolio standard deviation since inception is 18.86%, 24% lower than Nifty 50. If you look at portfolio beta against Nifty 50 on daily data, my portfolio beta is 0.77 versus Nifty 50 being 1. We've taken 23% lower risk than the benchmark
to deliver these returns. Now, how do we do this? Whatever our returns are decently okay. So we are not a risky fund. By data, by every drawdowns also you see COVID drawdowns on AG side. So that is one part. Being into how do we do this? We are in emerging monopolies and proven monopolies. What is proven monopolies? We divide India in 71 sectors. India can be divided in, according to us, in 71 sectors. In this 71 sectors or industries, we are finding that which entrepreneurs are trying to make it large and which entrepreneurs are struggling. And we make a team of 25 players. but we also have 10 substitutes. Okay, like how you have a cricket team, the top 25 are always there, but always you have 10 players on your watch list or, कोई injured हो गया है. If any player of my team gets injured, I'm here to win. I'm a Stallion. I'm here to win the race. I replace my like the injured player, and I already have a list ready that ये हटाऊंगा तो ये लूंगा. Those 25 players, till the time you don't get injured, you're part of my portfolio. But if you get injured, we will have to shift you till the time you're back to 100% fitness levels. So we are finding or trying to find in these 71 industries across, like Varun
said in a very, very good way, that power sector. We also are looking at power also. We are looking at power is divided in renewables, transmission, cables. Up cables may we have one player, Polycab.
Polycab is bigger than RR cable plus KEI plus whatever. Havells. He's the fastest growing guy.
This quarter, Havells grew at 7%. KEI grew at 15%. RR cable grew at 11%. Polycab growth was 18% after not working for 10 days because of the income tax rate. Last quarter. So we keep tracking that the market leader is gaining market share or not. So every time we keep doing that, and so historically we've been 55% large cap, because as Varun said that we are still chasing growth. Historically we've been 55 for last 66 months since inception till date. We've been 55% large cap. As Varun said, it is not about अगर 100 करोड़ से 300 करोड़ हो रहा है या 300 करोड़ से 900 करोड़ हो रहा है. It is about every industry who's scaling faster. It is the rate of change that matters. So we've been 55% large cap, 25-24% mid cap, and 12-13% large cap automatically, not by choice, automatically. And been proven monopolies are more like larger bets. Like Varun Beverages, it's now a proven player in our portfolio, but it is still growing at 20% plus. Why do I sell a company which is growing at 20-25% plus, where HUL, Varun said, is growing at 2-3%, ITC is growing at 3-4-5%, your Dabur is growing mid-single digit. So when my player in consumer, DMart is growing at 19%, Varun Beverages still is the fastest growing FMCG player. We have now found a new player, but we are building positions, so I will not speak about that. But Varun Beverages is still the fastest growing. Till the time Jaipuria ji and me are not friends. He made it large because of Pepsi, increasing geographical reach of Pepsi, and then Sting. I didn't know he will do it that well. But every quarter he was executing, I was with him. Today also, till the time Jaipuria Saab executes, I'm with Jaipuria Saab. If someone else does well, I will move there.
So I'm like the most unemotional investor. I book losses also. My pre-fees returns, and this is just one more part. My pre-fees returns has been about
480% for last 5.5 years. My net of fees is 410, something like that. My top 11 winners, we made once. Top 11, why did I take 11? Because it's a cricket team example. Top 11 winners, we made 168%. My top 11 losers, we lost only 8%. What are we doing? We are riding our winners and we are cutting our losers. Fundamentally, that is what we do. So, injured हुआ, हटाओ. Injured हुआ, हटाओ. जो अच्छा कर रहा है, चलते रहने दो. And we keep giving bonuses also every quarter. If any employee does well, what do? You give him bonuses. Or if someone is not doing well, what do? You cut salaries. We do that every quarter. हमारे portfolio में अगर 25 stock है, 5 stocks we give bonuses and 5 stocks we cut salaries also. From my promoters, I cut their salary as in reduce their weight of the portfolio. Then that is what we do.
Good, nice. So for you, Varun, that your product portfolios are very concentrated, right? So how do you really balance the risk and the returns?
So the debate on concentration versus diversification, I would be, I'll accept with all humility, we have studied so many funds across the world and in India, somehow there has not been an answer. But through our own practice, today ValueQuest has completed 13 years and delivered through all these 13 years, 3, 5, 7, 10, 13-year returns are there publicly available. We have found that our sweet spot is like 10 to 12 companies, and then there could be some tails, so effectively 10 to 15 odd companies. Now, why 10 to 15 odd companies and why we feel it's not risky is because of Pareto's law, right? What is that? 80-20 ratio. In every industry, there is one or two champions, right? For example, and one is growth, the other is capital efficiency. If you include both of them in the market, अपने को लगता है इतनी बड़ी country है, effectively you'll barely find at any given point of time 50 to 80 companies which are growing above nominal rate of growth and delivering you well above cost of capital or healthy return on capital. The share of profits is always skewed towards one, the leader or the challenger, maximum the third guy, but there is never a fourth person across industries. So one of the reasons why when we pick one or two companies, it well represents the industry and the theme, right? About risk and volatility are two completely different animals. Risk is one, if you do not invest enough, if you take enough market timing calls. Third, if you're not riding on industry themes and companies which are consistently or suddenly starting to grow above nominal rate of growth. And you are taking the risk being complacent about past winners, about past laurels. I'm sitting at Bangalore and I'll still take the names. How does it matter if the top 5 IT companies, whatever rate they grow at, the maximum they can grow at is 8 to 10%. Why should I spend my life in analyzing, paralyzing, and looking there? There is enough and more opportunity in this country, even within the IT. If you go back to non-IT, consumer or manufacturing, there is even more. Even within IT, I want to spend my time and life in companies which are at least growing at 20%.
So, good. Sonam, I have a different question for you. You have shared in a post, right, about an alternative data needs to be organized. So I wanted to understand what you mean by this and your take on ESG as a theme in these investments.
Right. So I think, we've been all been talking about growth that the companies have been showing and all these numbers that we invest based on. But the thing is that this number comes at the end of the quarter, right? What is the company has grown, it will come at the end of the quarter. But unfortunately, the market starts moving before that number comes, right? So if a company is going to post good numbers, you see the movement happen even prior to that. And therefore, in the history of the Indian market, what we have seen is the guys who were doing the insider trading, they ended up making the most amount of money, right? They had quicker access to knowledge. So when we are doing alternative data, the idea is that the news about the results, right? The results that are going to come, what the growth of the company has it done some acquisition? How is the sentiment around the company changing? Or is there a red flag, right? That could have been flagged, right? Is there a management change that happened? Is there a bankruptcy rumor that started? So what we're trying to do is alternative data means that you get access to the news and the unstructured data and the filing, and you extract these signals from there. So before the financials can give us that data, we have access to that signal. And again, ESG also comes into play. Any environmental concerns, any social responsibility, corporate governance, these things have long-term impacts on stocks, right? So those type of signals, a company will come on and tell you that I have the best ESG, but a lot of that implications come from the news cycle and the unstructured data also. So getting all those signals from unstructured data, I think, can really enhance the process. So I'll tell you about our process. We do use fundamental, technical, and all that, but a very important signal that I use is consensus estimate that these analysts are giving, right? So I know there are smarter people than me out there, and their estimates, how they change, will have bigger impact on the stock, right? So getting as better data sources, getting access to this
Basically,
information.
people used to call
Yeah,
that
yeah.
in technical parlance, right? Leading indicator, lagging indicator. So you're
Definitely.
saying,
Yeah,
don't wait
yeah.
for quarterly results. Give me the data before
Yeah, yeah, I
information
think
flow
that is
before
the
that.
edge, right?
Yes, that's the edge. Yes. Over to you, Anil. Considering how AI has found applicability, right, in almost all aspects of financial services, can you explain the role of AI in your alpha bot products?
Yes, first of all, let me get back to why we chose a fund like that, right? And uh, like I said, I like diversification, different themes and different styles. Uh, Now we have, let's say, a mid-cap portfolio, which is, in fact, we created a methodology there saying, a multi-bagger methodology that gave us almost like 20 multi-baggers with anywhere between less than a year to 3 year type of a time frame. So those are things that process was always important to us. So uh, the way I looked at it as a de-risking for my business. Okay, because being in Bangalore, seeing disruption, okay, I just said, what if disruption happens to my core fundamental, people-based investment management business, right? So I said, one was searching for that, and then got across to probably somebody who has the longest experience globally as well in investing in AI, because like Sunam said, basically one has to be cautious because you're handling other people's money, right? And they ran an index on Nasdaq for almost 7 years, which they stopped in 2019 because it's too costly, and they started getting assets and working with institutions by that time, right? So they didn't need it sort of going forward. And we took 3 years before we onboarded, we tested it stuff, got live on it before we actually onboarded clients. Then we took another 3 to 4 years of seeing it live in terms of what we do. So what does the AI thing do? It actually looks at an advanced indexing technology, right? So which today maybe our indices are market cap weighted, and advanced indexing actually takes it off to a next level. Yes, to some extent, to that extent, yes, it is a little bit of a black box, which we also try to explain on various parameters how it does. We've had good periods of time and not so good. Okay, right now it's because we kept on refining it. Because my point was, how do I add in risk management more and more into it? And those are some of the instances, like how does the system look at an Adani type of issue? So today, I think AI, the way I look at it, is something of the future. From here, I believe after having looked at it for almost 5-6 years, I think it's something that is there and will only get more and more dominant. And which is why I wanted to offer it as one of the diversifications for investors. It need not be the heaviest weightage portfolio right now, but I think that's something for the future.
Got it. Last question to you, Amit, on margin of safety, right? You don't use PE ratio, but you instead focus on capital allocation and distribution. So can you tell how that helps you to find that margin of safety?
We use P ratios also. We use everything, to be honest. If someone tells me we are in the business of making money, we are not, that style and everything is secondary for us. Like if today AI, I see anyone making money on AI, 2 years from today, 3 years from today, I swear, come what may, I will try to be the best in AI also. And I'm learning from Sonam now. Anilji, I didn't know he had a AI thing. We are in the business of making money. Simple. Now all these are steps and processes, and you have to be a self-learner. We're in the business of learning. What worked 10 years before today may not work 10 years after today. And if I see data, if someone is actually making money from AI, then I will go there and do AI also, believe me. So because my goals are simple. I want to make money for my customers. But to your point, do we see valuations? It's a very, very important. We play discoveries. We want to make money on earnings growth and valuation both. But the way we value companies may not fit. Like Zomato, if we bought at, giving you an example, at 80,000 crores market cap, with 10,000 crores of cash on books, 2 quarters before today, 2.5 quarters before today, we bought at 84 rupees a share. We understood that time that this will make 2,000 crores PAT. So I was buying a 50-60%, where Dipinder had given a guidance for next 3 years, he'll grow at 50%. Growing consumer facing duopoly at 40 times 1 year forward. These brokers had PAT estimates of 500-600 crores that time. We understood that how the business works, and we worked harder and we made a fortune. We doubled our money. Same with MCX. We bought MCX 2 quarters before today at 10,000 crores market cap. Now all brokers are speaking about 500 crores of PAT estimates next year, and no exchange trades in India less than 50 PE right now, except NSE, of course. But like all capital market stocks who are monopolies like CDSL, CAMS, they used to trade at 40 to 60 times. So we know how market should react, and we know where we are buying it 1 year forward. So all our stocks that we buy, we bought Nuvama at 2,800 crores, at 2,800 rupees a stock. And we had a large US popular investor selling to us. So I'll give you an example. We bought Nuvama at 9,000 crores market cap, where the expected profits was 600 crores, 15 P. This happened last 2 quarters back. Anand Rathi that time used to trade at 50 P. IFL 361 used to trade at 35 P. The ROCs were higher for Nuvama compared to other guys. The growth of Nuvama, last quarter, I'll give you an example. Last quarter, Anand Rathi grew at 30%. IFL grew at broadly revenue, if I'm not wrong, I might be wrong, 15% or something. Nuvama grew at 38%. I was buying the growth leader, the ROE leader, and an MNC management because it's owned by PAG at 1/3 or half the valuations. So I had my own margin of safety. And people think that we bought Nuvama. When you are buying larger quantities, the research happened the day Edelweiss did the demerger. So we were prepared and we were already working extremely hard before making that decisions. For us, valuations matter. But that P multiple is not the only way to do valuations. You have to, a value of a stock will always depend on future cash flows today. So I can go on and speak for 1 hour. Actually, the session should have. But for me, it is future expectations of earnings, growth, ROICs, management, size of opportunity. There are not one simple thing of valuation. Where opportunity size is very large versus opportunity size is very small, the valuations will always be different. Yeah. So
great. Thanks. If any one of you want to ask a question, any audience who wants to have any particular question?
My name is Pradeep. I have a question for Amit. He, in the beginning of this conversation, told that per capita income is going to drive the growth.
Yeah.
And he referred to US economy and others, maybe China and all. There, it's a structured economy. Everybody pays taxes. So everybody's income is also, it's accounted. In India, only 4% of the people pay tax. Maybe 8% file returns, 4% nil, 4% actual taxpayers. So 96% are not even paying taxes. So their return, their income is not even known, right? How do we know per capita income is going to drive the economy, right? So
GDP is done by consumption plus investments plus, like imports minus imports. So GDP में सब कुछ आ जाता है, black, white, सब कुछ आ ही जाता है. So you don't have to worry about that. But black money and all that driving, it's only the farm, I would say. But see, I'll tell you, 1% of any economy pays the maximum taxes. इंडिया में भी जो 1-1.5 करोड़ लोग हैं वही तो पूरा पैसा भरते हैं ना. 2 लाख लोग हैं जो 1 करोड़ के ऊपर टैक्स का वो दिखाते हैं, like more than 1 crore. See, the taxes will always be more for the richer, less for the not so rich, and it is fair. It's okay, yaar. See, we are at 2. See, that is what the driving. See, some people say it's an opportunity also. That if so less people are paying, there will be more and more because everything is moving white. See, 7-8 years before today, the first question when people would invest money would say, yaar, koi hai kya tarika black to white karne ka? This is for every fund manager. Every आप बड़े व्यापारी से बात करोगे यही बात करते थे that कोई है क्या तरीका, मेरे को black पैसा है, I don't have white money. That is how the conversations would start. In last 3 years or 4 years, I should say, I do not even hear that kind of conversation. There is no thing as large black money. At least the ones who are speaking to me don't tell me about this thing. All money, majority of the big boys, the family officer, they do not have black money. सब 25%, 30-40% टैक्स भर के अपना वाइट करो, जीवन सही जियो, पैसा तो कमा लिया, शांति भी चाहिए दुनिया में.
Just to add in this, I think there has been good changes, demonetization, GST, so many tax, right? So they were talking about the confluence, and that confluence and digital economy is really helping money to come into the white, and that is really changing the things. Yes.
Do you think India will have those capabilities to back it up with execution, or will we go wrong in the whole thing?
Basically, there are challenges, right? So,
Right? I mean, what do you see?
put
Right?
this
We
question
talk
to you,
about all
Varun.
the rosy good things about India growing and etc.
Got it. So
What can go
I'll
wrong?
add one or two points in this.
No,
So
very, very
there is a problem of small and medium companies not getting capex loans and that investment also, plus this execution capability, right? But until unless these guys execute, India execution will not be seen on ground. Yes.
No, very valid point. We were not thinking big enough. Okay, in the post-Nehruvian thing, we were breaking down companies rather than consolidating into industry leaders. But there are three trends that are happening structurally in India. One, politicians are the first time getting admired and looked up to. Otherwise, movie stars, cricketers were the only thing. Second, financialization. No second generation wants to go real estate, gold, FD in terms of savings. All that money is coming to risk assets. It could be alternates, mutual funds, any kind of risk. The ability to take risk has increased. That is providing. Today, aren't you hearing enough capital raise happening through promoter dilution, private equity, venture capital, SMEs? Capital availability in India has significantly improved. Earlier, capital availability was a big problem. So India is doing close to $40 billion of private equity primary capital raise every year. Primary capital raise. I'm not talking about secondary, okay? Now, in terms of your question of are we thinking big enough, okay? Let's say two industries, renewables, okay, new energy. 2 hours from Bangalore, 20 gigawatt of battery factory is starting in the next 12 months. 20 gigawatt. I would say 10 years back, we were not thinking in terms of 20 megawatt. So our capexes across electronics, defense, solar, battery manufacturing, semiconductors, power assets, everywhere we are thinking really, really big. The solar rooftop scheme, let's forget about the utilities part. India is doing close to 40 gigawatt of annual solar renewables tendering. Already has happened. 10 gigawatt of wind, 20, 30 gigawatt of annual battery manufacturing. Semiconductor is just starting. I think now our scale of thinking has changed. So I don't see that. Also, there is a lot of support from global technology providers, licensing, MNCs. It's not just China plus one, it's also Europe plus one. Europe plus one is happening before China plus one. So I think our scale, and one of the independent variables to our thinking, apart from capital availability, is logistics. Our roads, railways, supply chains have improved significantly over the last 7-8 years. In fact, post 2014, I would say, from here with, I think it's an easier path. So I don't think so. Thinking project execution. Pehla bullet train banega, the country will say more can be replicated. The bullet train is probably not an economically a good investment. It's a 75,000 crore investment. You can create 100 airports out of that. That's not the objective. The objective is once you create one large scale projects, the confidence of the country increases manifold to execute. You've seen the roads, right? You travel across the country today. The kind of road infrastructure that we have today is unimaginable 10 years back. So please have faith. We are really executing at scale now.
I just want to make one point on this.
Please,
I think two questions came comparison with the US, and almost like, we are second grade, right? So I think the first thing that we need to keep in mind is we should have the confidence in ourselves. And you will actually go back and see automatically anybody who's moved from $2 to $5 trillion, that transformation happens. right? We believe in ourselves, and I'm sure we will do great. And what I don't think people imagine today, you go back and see all the global reports. They are all talking about us who are doing great, right? I think it's time for us to also have that confidence.
In whatever parameter and numbers and the growth estimations of economy you see, whichever report you see, India growth numbers are like outstanding, not only in the past but also in the projections, right? So I think very well summarized. There is
one line. 2013, the median PAT of BSE 500 was 180 crores. Today, the median PAT is 570 crores. Every 10 years, your median PAT itself is tripling. So 10 years from now, BSE 500, the median PAT is going to be 1,500 to 2,000 crores. Just think about, the way the sizes are.
great. Yeah, please, one last question then.
Hi. So, question for all four. Do you all, on a personal level, do you all practice asset allocation? And as a follow-up, I'd like to know how much of your net worth is in your own products.
I'll start. Mine is very easy. Except my house, 100%. So I'm fully invested, and that too in Stallion. Like I might have one NSE investment, but except that, I have my skin, body, hair, shoes, everything in the game.
Yeah, so today I think everything that we do goes into our fund. For a period, we said there's too much of compliance issues, so we didn't invest a single rupee in our own fund. Okay, because I said this whole compliance stuff had to be taken care. So we got that confidence and said that today everything actually goes into it. Debt that we have is only for liquidity, right? And yes, there could be, let's say, asset purchases and all of that happen. So significantly still equity, but there would be gold, there would still be thing, but they will be smaller percent.
How about
I
you?
think the same for me as well. I have everything in the strategies that I manage. And not just me, I think all of my family, my father, my sisters, everybody sort of is invested. So yeah, a lot of skin in the game. I think that's what we did, right?
Okay.
My family has lost capital in 92 crash, 96 crash, yet our bhakti remains on equity. We don't understand anything else. 100% or always 100% equity. We are fine with 50% drawdowns every 10 years. Despite that, equity returns have been most gratifying.
Great.
Thank you so much.
It was really a very good conversation with you guys. Thank you very much.